A series of sizable uptrends begin a gradual slope for a potential recovery following a large downtrend. The first one is from an inverse head and shoulders formation. The head and right shoulder upswings form too steep of an incline to be considered a double bottom variant, but instead form a simple transition into an uptrend with consecutively higher upswings. Additional strength behind the eventual recovery comes from the double bottom, with the second bullish reversal. The final bullish reversal starting 2002 is another example where a double bottom has an incline that transitions into an ascending triangle. Here is a great example of a declined triple top starting a considerable bearish reversal. It was more difficult to identify during its formation due to its small size. The first and second downswing points were especially difficult to spot at the time, as they were much less clear than the third. The lower boundary, on the other hand, has a very clear price action with clear short-term support, but on an overall bearish tone in the broader context. This is seen with the strict bull hammers that are negated by neutral to bearish candles after them. Even though there is no volume, the large red candles are more than adequate in identifying decisive breaks lower. Similar to the beginning of the last example with the JNJ chart, there is a descending triangle that can be outlined with a large and a small variation. Here is a less common occurrence where a strict double top is moderately sized, but completes to produce a relatively small drop. This is due in part to the role reversal taking place, as trading recontacts the old declined triple top range. It now provides crucial support in what later turns out to be a series of moderate pullbacks in a stable bullish continuation. March 2008 is defined by a large-scale downtrend that is eventually halted by an inclined triple bottom and a strict double bottom, though this doesn't turn into a sustained recovery as 2010 begins increasingly bearish. The developing uptrend exemplifies why horizontal double and triple bottom ranges are usually easier to identify compared to reverse head and shoulders, because of their less complex and variable features. As the large-scale downtrend progressed, a flat range eventually emerged and presented a noticeable incline prior to the next sizable uptrend from early 2017. Towards 2017, there is a gradual transition from a defined downtrend to an uptrend in the general outline of a reverse head and shoulders, though this could have been difficult to see if attention was not directed to the bigger picture, due to the many swing points forming the head, left, and right shoulder portions. Near the end of 2017, the new uptrend is slowed by a relatively small head and shoulders in September, when expanded to include the August and October downswings. A larger variation of a head and shoulders within a head and shoulders emerges. The resulting downtrend into November is of little consequence, as long-term bullish sentiment remains constant to maintain the progressing recovery. A double top has failed to produce an immediate drop, but there is a noticeable decline with the following downswing points. The double top could be considered failed or extremely delayed. In any case, the main bearish sentiment was not lost, since the steady decline also presented a defined descending triangle, and the characteristic bearish surge after breaking the lower boundary that is shared with the double top. This is a strict descending triangle outline, but it is in a disadvantageous context for a bearish continuation, as the late March upswing was already quite strong with a whole week of consecutively higher closes. This was prior to the firm triangle base that was holding support for the bullish context of the early uptrend, rather than a weakening range under the context of an existing downtrend. Given the context from the weeks leading up to April, the formation is more accurately outlined as a horizontal range, or even a triple bottom range, reversing the small downswing. There is the feature of an ascending triangle furthering the development of the trend's main incline. This is followed by the distinct bullish break and 3 marching soldiers price action into June, following strong closes above the neutral to increasingly bullish reversal range. This could have ended as a double, triple, or flat top, but it ends as a variation of a more compact head and shoulders. Regardless, the main feature of significance is a break of the lower boundary shared by all bearish reversal patterns. In the short term, there is a natural bullish retracement, and the lower boundary will become a natural resistance area to watch. While the neckline range does resist the bullish retracement, the head and shoulders range is eventually surpassed with another bullish surge, making the overall formation a neutral to bearish resting phase in a classic bullish continuation. The head and shoulders was also small and compact, so it was less of a surprise when the neckline and drop were weaker and short-lived. This case study has been an exercise in focusing on the general outlines of patterns, mostly in medium to long-term contexts, and not necessarily relying on the precise marking of levels and ranges. A look back reveals the easy identification of patterns that overlap and share ranges of significance. Such an approach can help sharpen pattern identification skills and make for a less cluttered chart.